Priya and Daniel are the people you were supposed to envy. March 2021. Denver, Colorado. They close on a 4-bedroom house, $480,000, 30-year fixed mortgage at 2.9%, monthly payment $2,002. Their friends called them lucky, their parents called them responsible, their bank called them qualified. Daniel is a senior software engineer. Priya is a product manager. Together, they earn just under $200,000 a year. They have equity. They have stability. They have the asset everyone said they should own. In the spring of 2025, Daniel got a job offer from a major tech company in Austin, Texas. 40% salary increase, career-defining role, the kind of opportunity that appears once. They turned it down. Not because they didn't want to go, not because the job wasn't right. They turned it down because their mortgage made it mathematically irrational to move. They are not in financial trouble. They are not underwater. They own a home that is appreciated in value, and they are completely trapped. By the end of this briefing, you will understand why Priya and Daniel's situation is not an accident, and why the research documents that people like them, multiplied across 40 million households, may have broken the housing market for everyone who came after them. Here is the puzzle this research presents. Priya and Daniel's mortgage rate, 2.9%, is so far below current market rates that selling their home and buying a comparable one in Austin would nearly double their monthly payment. The same square footage, the same life, nearly double the cost every month for 30 years. The 40% salary increase that looked transformative on paper becomes, after tax and after the mortgage differential, financially marginal at best. The mortgage, an asset, became a cage. And the research documents that Priya and Daniel are not alone, not even close. To understand why Daniel turned down that job, you need to understand what happened to mortgage rates between 2019 and 2023, and why it was unlike anything in modern American financial history. In January 2019, the average 30-year fixed mortgage rate sat at 4.5%. Historically normal, historically manageable. A family buying a $350,000 home paid roughly $1,770 a month. Then, the Federal Reserve intervened. In response to the economic collapse triggered by the pandemic, the Fed cut interest rates to near zero and began purchasing mortgage-backed securities in enormous quantities, a program designed to keep borrowing costs low and stabilize the housing market. It worked. By January 2021, the average 30-year rate had fallen to 2.65%. The lowest ever recorded by Freddie Mac's weekly survey, which goes back to 1971. 21 months of historically cheap money, and millions of American households locked in those rates for 30 years. Then, in 2022, the Fed reversed course sharply. Inflation had accelerated. The Fed raised the federal funds rate 11 times in 14 months, the fastest tightening cycle since the 1980s. Mortgage rates followed. By October 2023, the average 30-year rate hit 7.79%, the highest in over 20 years. The people who borrowed at 2.9% were now sitting on an asset that could not be rationally exchanged. The golden handcuff was locked. The Federal Housing Finance Agency, the regulator that oversees Fannie Mae and Freddie Mac, published a research paper in 2023 documenting what it called the rate lock-in effect. The finding was significant enough to be cited in congressional testimony. Let that number settle. 85.7% of mortgaged American homeowners, as of early 2024, held a rate below the current market average. That is not a small cohort. That is nearly the entire existing homeowner base simultaneously unwilling or unable to sell. The FHFA research found that for every 1 percentage point gap between a homeowner's existing rate and current market rates, the probability of that homeowner selling drops by 18.1%. Priya and Daniel's gap between their 2.9% and the 2025 market rate of approximately 6.8% represents a nearly 4 percentage point differential. The math suggests their probability of selling, all else being equal, is suppressed by more than 70% compared to a homeowner with a market rate mortgage. They are not being irrational. They are responding correctly to an incentive structure the market created. But the lock-in effect isn't just Priya and Daniel's problem. The research documents that it changed the math for every buyer who came after them, including people who had nothing to do with the pandemic market. Here is where the research becomes systemic rather than personal. When 85% of existing homeowners stop selling, the supply of homes available for purchase collapses. The National Association of Realtors documented that existing home inventory in 2023 fell to its lowest level since records began in 1999. Not low, the lowest ever recorded. Basic economics. When supply collapses and demand remains, prices rise. The FHFA research estimated that the lock-in effect alone, independent of other factors, added 5.7% to national home prices between 2022 and 2024. On a $400,000 home, that is $22,800 in price inflation, caused not by construction costs, not by land scarcity, but by the immobility of people who locked in cheap rates during the pandemic. The typical first-time buyer is now 38 years old, 7 years older than the historical average, a generation that was told homeownership was the cornerstone of wealth building is arriving at the closing table a decade later than their parents did, and paying nearly double the monthly cost for the same asset. 56% of recent buyers have taken on additional non-mortgage debt since purchasing their home, just to maintain their standard of living. Not to upgrade, to maintain. And in September 2024, according to Redfin Research, the estimated monthly cost of buying a home was 29% higher than renting the identical property. Buying is not just expensive. In most markets, in 2024, buying was the more expensive option month to month, before maintenance, before property tax, before any illiquidity premium. Priya and Daniel's 2.9% mortgage did not cause all of this. But the research documents that 40 million households holding similarly cheap rates simultaneously created a supply freeze that made the market dramatically worse for everyone who came after them. The lottery winners and the locked-out buyers are two sides of the same mechanism. The research presents a paradox that the housing market has never navigated before at this scale. Every homeowner who locked in a rate below 3% made a rational individual decision. They secured cheap financing when it was available. This is exactly what financial literacy education told them to do. Lock in low rates, build equity, own rather than rent. And in aggregate, 40 million rational individual decisions created a market condition no individual decision-maker intended. A near-complete freeze of existing housing supply, lasting years with no clear resolution mechanism. The FHFA framed it in terms that deserve to be read precisely. There is one sentence in the FHFA research that reframes this entire situation. Once you hear it, Priya and Daniel's story stops being about one couple in Denver and starts being about the architecture of the American housing market itself. The lock-in effect represents a fundamental misalignment between private incentives and market function, where individually, rational behavior produces collectively irrational outcomes at scale. Priya and Daniel are not the villains of this story. Neither are the first-time buyers who cannot afford to enter the market. The research points to something more uncomfortable, a system that produced predictable, documented harm as the direct consequence of its own success. The pandemic mortgage program worked exactly as designed, and what it produced, in combination with the fastest rate tightening cycle in 40 years, was a housing market that functions worse at higher cost for a smaller proportion of the population than at any documented point in modern history. The research does not offer a clean solution to a structural problem, but it documents three patterns among households navigating this environment that are worth understanding. Research from Redfin's 2024 housing study documents that households which separated the housing decision from the mobility decision, evaluating whether renting in the destination city for 1 to 2 years before purchasing was financially superior to buying immediately, preserved an average of $28,000 in liquid capital over a 24-month period compared to households that bought on arrival. The research found renting in the destination first was the more capital-efficient approach in 67% of high-cost metros studied. The Federal Reserve Survey of Consumer Finances documents that households in the top wealth-building quartile consistently treat housing as one component of a diversified asset strategy, not as the primary or only wealth vehicle. Among households that built measurable net worth between 2019 and 2023, the majority held housing alongside liquid assets, index funds, and income-producing investments. The research does not document households that were exclusively house-rich and liquidity-poor in this wealth tier. FHFA and Freddie Mac's 2024 Housing Outlook research projects that the lock-in effect will begin to weaken naturally between 2025 and 2027 as homeowners face life events, job changes, family size changes, divorce, retirement that override the financial incentive to stay. The research documents that households which modeled a 3 to 5 year scenario rather than making a permanent never sell decision were better positioned to respond to improving market conditions when rate normalization eventually occurs. Capt Liquid presents research findings for educational purposes only. Nothing in this video constitutes financial, investment, legal, or tax advice. All data cited from named institutional sources. Consult a qualified professional before making any financial decision. The housing market didn't break because of greed or incompetence. It broke because 40 million rational decisions, made at the same time in response to the same signal, produced an outcome nobody designed and nobody can easily unwind. Priya and Daniel are still in Denver. The job offer in Austin is still the right career move, and their mortgage is still 2.9%. In Episode 3, we look at the asset that has quietly outperformed homeownership in 11 of the last 15 years, that requires zero maintenance, zero property tax, and that the financial services industry has a documented financial incentive not to explain clearly. Stay liquid.